Hey, welcome back. It's Jason Walter here. With mortgage rates near record lows of around 3%, there's been a surge of homeowners refinancing their mortgages right now. For example, according to the Mortgage Bankers Association's latest weekly survey that was just published today, 62.6% of all mortgage applications were from refinances. In addition, MBA's refinance index was 34% higher than the same week 1 year ago. However, just because interest rates are near record lows, that does not mean that everyone should refinance their mortgage. So here's 4 reasons why you should not refinance your mortgage. But before that, please subscribe to this channel if you haven't done so already, and hit the like button if you appreciate videos like these. Thank you so much for doing that, and let's get back to the video. My first reason why you should not refinance is when you be paying too many points in order to get a low rate. If you watched my video from last week, I talk about this, but points are basically the fees that you pay in order to reduce your interest rate. And 1 point equals 1% of your loan balance. So for example, if you have a $300,000 mortgage and you have 1 point, that is $3,000 extra in fees. Therefore, when you pay points in order to get a lower rate, that increases the closing costs for you to do a refinance. If you pay too many points, this may take you many years to break even after you take in consideration all the closing costs you pay in order to do a refinance. And that leads me to my second reason why you should not refinance. My second reason why you should not refinance is when it's going to take you too long in order to break even. So let me explain. In order to refinance your mortgage, it is definitely not free. There are closing costs associated with that beyond any points that you may pay. So I'd recommend to calculate what your break-even point would be, and here's how to do it. First, determine what your total closing costs would be in order to do a refinance. So closing costs would consist of origination fees, title and escrow fees, possibly an appraisal fee, and any prepaids. And prepaids basically means any portion of your property taxes or your home insurance that you have to prepay in advance. In order to determine what your total closing costs would be for doing a refinance, ask your loan officer for a loan estimate. You also can take this loan estimate and compare that lender to lender when you're shopping for interest rates. That way you can compare fees that each lender charges. The second step after you calculate what your total closing costs would be is calculate how much money you would save per month after doing a refinance. Take your current monthly mortgage payment and subtract what your new monthly payment would be after doing a refinance. The third and last step in order to calculate your break-even point would be to take your total estimated closing costs and divide that by the monthly savings of doing a refinance. That will give you the number of months it'll take you to break even. So let me give you an example. If your total closing cost for doing a refinance is $10,000 and you would save $200 a month on your mortgage payment if you were to do a refinance, then it would take you 50 months in order to break even, or just over 4 years. A key point here is that in this example, it would not make sense to do a refinance unless you plan to live in the house for at least 5 years. If you move prior to that 50-month period of breaking even, then it would not make sense to do a refinance, and that'd be money wasted. Therefore, before moving forward with a refinance, take into account your closing costs, what your break-even point would be, and then get a gauge for how long it's going to take for you to recoup those closing costs. If I lost you, just comment below and I'm happy to explain or answer any questions you may have regarding this. On a side note, but also related to closing costs, do not forget that there is a brand new fee that was just announced 2 weeks ago for homeowners who want to refinance their mortgage. That new fee is equal to 0.5% of the loan balance of the majority of Fannie Mae and Freddie Mac refinance loans. So for example, on a $400,000 loan, that's going to be an additional fee of $2,000. In my opinion, this is very poor timing on introducing more fees, especially during this pandemic. A third reason why you should not do a refinance is when you want to do a cash out refi. And there's one exception to this rule, but let me briefly explain what I mean by a cash out refi. A cash out refinance basically means you take cash out from the equity of your house. But the downsides of this is that the interest rate you pay for your mortgage is going to be slightly higher. In addition, for the amount of money you take out of your equity or house, that's going to increase your loan balance, so you are going to have to pay interest on this money. One reason why it may make sense to do a cash out refinance is when you want to decrease or eliminate high interest debt, such as credit cards. For example, the average credit card interest rate right now is around 15 to 18%. So if you have a large credit card balance that you're paying such a high interest rate, it may make sense to take money out of your house and pay 3% on that money and decrease your high interest debt. However, a word of warning here is that do not use this cash out refinance as a crutch. I'd still recommend you act financially responsible and do not spend more money than you have and rack up your credit card balances. On the other hand, I do not recommend you use the equity of your house by doing a cash out refinance in order to buy a boat or a Lambo. Very, very bad idea. I only mention this because, believe it or not, people do take cash out of the equity of their houses and buy frivolous things like boats. Avoid temptation. This happened during the Great Recession where home prices fell, people lost their jobs, they lost their houses, and they lost their boats. A fourth reason why you should not refinance your mortgage is when you're already very close to paying off your mortgage balance. For example, when you refinance your mortgage, you're going to have a brand new 30-year mortgage, for example. So if you only have about 5 years left on your mortgage, it just makes more sense to continue to pay your existing payment and pay off your mortgage in 5 years rather than adding on another 25 years to your mortgage. Please subscribe to this channel if you haven't done so already, and please hit the like button. I greatly appreciate that. You also can follow me on Instagram. I'm Sacramento Realtor. Also, don't forget to click on the link below because for a limited time, WeBull is giving away 2 free stocks when you deposit $100 on their platform. And that promotion actually ends on September 1st, so sign up before it's too late. Hope you have an awesome day and look forward to seeing you on the next video.